Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know First Fed's independence faces a perfect storm from the White House, Supreme Court, and AI's unpredictable economic disruption. We'll examine how this political battle threatens the Federal Reserve's credibility and may inject chaos into global markets. Second oil plunges nearly 20% in its steepest fall since the pandemic, creating a cartoonishly oversupplied market. So we'll discuss why this disinflationary shock challenges the higher for longer rate narrative and what it means for central bank policy. Third, UK workers face a real income paradox as rising wages are devoured by stealth taxes and surging household bills. We'll analyse why this policy friction creates a major dilemma for the Bank of England and how it could impact the pound. The US Supreme Court is set to decide if the president has the power to remove a sitting Federal Reserve governor. The hearing, scheduled for January 21st, centres on President Donald Trump's attempt to remove Governor Lisa Cook from the board. This legal battle is just the opening act in a political firestorm engulfing the central bank. This political pressure strikes at the very heart of the central bank's power, its credibility. The entire global financial system is built on the assumption that the Fed acts independently to control inflation and maintain economic stability, free from short-term political goals. If markets start to believe the Fed is making decisions based on politics, not data, it could create a credibility gap. This is dangerous because it could de-anchor inflation expectations and cause major volatility in financial markets. It follows repeated threats by the president to fire Fed Chair Jerome Powell over the pace of interest rate cuts. Now, with Powell's term as chair expiring in May, the entire leadership of the world's most powerful financial institution is up for grabs. A new chair is expected to be named this month after a process that weighed as many as 11 candidates for the job. Any perceived political interference, you see, could make the Fed's own guidance less reliable for investors. For example, the Fed uses a tool called the dot plot to signal its future interest rate plans. Normally, the market follows these signals closely. But if the Fed's independence is in doubt, investors might start ignoring the dot plot and pricing in their own more chaotic expectations, leading to more unpredictable markets for stocks, bonds, and currencies. A while back, we also highlighted a separate technical wrinkle. If AI-driven productivity ultimately lifts the economy's neutral rate R star, the dots can look misleading even without politics, because the true steady rate might be higher than the Fed assumes. This all sets the stage for a high-stakes battle over the Fed's future, just as its economic mission becomes more complex. The central bank recently delivered 3 consecutive interest rate cuts, but strong economic data and new, more hawkish members on the rate-setting committee are now pushing back. Here's where it gets interesting. The composition of the rate-setting committee, the FOMC, actually changes every year. In 2026, the new voting members will include presidents from the Cleveland and Dallas Federal Reserve banks, who are known for being more hawkish, meaning they favour higher interest rates to fight inflation. That change raises the bar for any future rate cuts, even if the economy starts to soften. We're already seeing this tension. The last rate cut in December passed with a 9-3 vote, but 2 members wanted to hold rates steady, showing a clear division within the committee. And as we discussed a while back, if R star is drifting higher alongside AI's promise, that hawkish tilt won't just be about the next meeting. It could imply a longer period of structurally higher yields, with the 10-year staying under upward pressure. According to Torsten Slock, chief economist at Apollo Global Management, economic tailwinds are accumulating, making it more difficult for the Fed to justify further cuts. So the Fed is caught in a classic dilemma. The situation presents a fascinating duality. On one side, you have leading indicators like weekly jobless claims, which give an early hint of where the economy is going, while on the other, you have lagging indicators like the official unemployment rate, which tells you what has already happened. The choice for the Fed is whether to cut rates preemptively based on a few bad leading indicators, risking a return of inflation, or to wait for the lagging data to confirm a downturn, risking a recession by acting too late. We've talked before about how AI could muddy this picture. Research we covered pointed to big productivity upside, potentially very large, alongside intense labour market churn, where workers move jobs and skill mismatches surge. Powell himself has cautioned we're going to have to see invoking the old productivity paradox, the idea that new technologies can take years to show up cleanly in the data. Translation: the labour stats the Fed relies on could look healthy or weak for reasons that are more about churn than trend, but that's not the whole picture. The ultimate wildcard is artificial intelligence. A massive wave of investment is flowing into sophisticated AI technologies, and the Fed must now calibrate policy for an economy being rapidly transformed. A few episodes ago, we flagged two added complications: the scramble for chips and energy that can create its own inflationary pressures, and stretched market valuations that raise the risk of an AI bubble correction if profits don't keep up. What's happening is that AI creates two powerful opposing forces at the same time. It boosts the supply side of the economy by increasing productivity, making the economic pie bigger, but a massive investment tsunami is boosting the demand side right now. Goldman Sachs projects that global AI investment could reach $200 billion by 2025. If this investment-fueled demand outpaces the productivity gains, it could actually push inflation higher. This complicates everything for the Fed. And as we noted earlier, if those productivity gains are real and persistent, they could lift the neutral rate, forcing the Fed to keep policy tighter than markets expect. As one chief economist put it, this is a really big potential pivot for policy that needs to happen at a time of maximum uncertainty. So, what's next? We need to watch a few key things. First, any further signs of political interference will be critical. Second, pay close attention to the internal debate at the Fed, especially the votes of the new hawkish members. Finally, watch investment data to see if the AI boom is creating more demand-side inflation. Building on our earlier discussions, also keep an eye on chip and energy bottlenecks, bond market signals about a higher R-star, and labour market churn that might not show up in the headline unemployment rate. It's crucial to track all this because these domestic US issues have global consequences. A more hawkish Fed generally means a stronger US dollar and higher US interest rates, which tightens financial conditions for everyone around the world. For an economy like China's, this could create pressure on the exchange rate and capital flows, potentially influencing the PBOC's own policy decisions as it navigates its own economic path. And remember, we've noted the global AI capital expenditure arms race with China racing to counter the US private sector boom. The Federal Reserve is no longer just fighting inflation. It is now at the center of a collision between the White House, the Supreme Court, and the unpredictable force of AI, creating a period of unprecedented challenge for the US economy and global markets. Speaking of the Fed's hawkish stance, an unexpected development in the energy market is now challenging that very narrative. Analysts are calling the global oil market cartoonishly oversupplied. Oil prices just suffered their steepest annual fall since the COVID pandemic, slumping by almost 20%. This marks the first time the market has recorded 3 consecutive years of annual losses. This sharp drop in oil prices is what economists call a significant disinflationary shock, impacting far more than just the energy sector. If oil prices stay low, it could help central banks hit their inflation targets much faster than expected. This could lead to earlier than expected interest rate cuts, challenging the higher for longer narrative that has dominated financial markets. And believe it or not, this price collapse is happening despite ongoing conflict in some of the world's most important energy producing regions. Normally, conflict in the Middle East or Europe would add what's called a geopolitical risk premium to the price of oil. That's the extra cost buyers are willing to pay to secure supply when they're worried about disruptions, but that premium has effectively vanished. The market appears to be ignoring the sheer scale of the risk. For example, the Strait of Hormuz, a key choke point, handles about 21% of all global petroleum consumption. Any real disruption there could cause an incredibly sharp price spike from these low levels, catching a complacent market completely by surprise. The reason is a massive supply glut. The International Energy Agency expects supplies to outstrip demand by a staggering 3.8 million barrels a day this year. And the pressure is about to intensify. As leaders inch towards a potential Russia-Ukraine peace deal, the market is bracing for a flood of new oil if sanctions on Russian exports are lifted. This has driven crude below $60 a barrel for the first time in almost 5 years. This isn't just a market story, it's a power struggle. OPEC is trying to manage production to keep prices stable, but the market is awash with more crude than global industry can absorb, partly due to weaker economic growth and the lingering effects of a trade war against China. That brings us to China. where the slump in oil demand is a powerful, real-time signal of a deeper than reported slowdown in its industrial economy. In fact, China's crude oil imports just saw their first annual decrease in 2 decades, excluding the pandemic years. When the world's primary engine for commodities falters like this, it can export deflation to the rest of the world, impacting global growth. This also puts extreme pressure on OPEC, which revolves around the fiscal break-even oil price, the price a country needs to balance its national budget. For a major producer like Saudi Arabia, the IMF projects their break-even price is over $96 a barrel. So when oil is trading in the $50 range, it creates a massive budget deficit and tests the group's unity. This raises the risk of a 2020-style price war if members decide to abandon their production quotas to fight for market share. So what happens next? Top analysts at major investment banks like BNP Paribas, JP Morgan Chase, and Goldman Sachs all expect prices to continue falling, potentially hitting the low $50 range a barrel. However, if you zoom out from the global markets to your own wallet, there's a disconnect. While wholesale oil prices plummet, fuel retailers are under pressure for keeping prices at the pump stubbornly high. And in places like Great Britain, households are facing a surprise increase in their regulated energy bills. It seems there's a breakdown in what economists call price transmission. The savings from cheap crude aren't being passed through to you. For example, the UK's Competition and Markets Authority recently reported that even as wholesale costs fell, retailer profit margins on fuel remain far above historic levels. This means that unlike in past oil slumps that gave consumers more spending money, this time households may not feel the benefit. The result is a global market drowning in cheap oil, while many consumers see little to no benefit. We were just talking about how consumers aren't seeing the benefits of falling oil prices, and that theme of household financial pressure continues in our next story, this time from the UK. Let's start with a decision that will change how millions of people pay every day. The £100 limit on contactless card payments is about to be scrapped entirely. Starting March 19th, card providers can set their own limits. But if that was just the appetizer, the main course is a major conflict brewing between rising wages and stealth taxes. While nearly 3 million workers are getting a pay rise, with some younger workers seeing an 8.5% wage jump, frozen income tax thresholds mean many will be pushed into a higher tax bracket. This phenomenon is known in economics as fiscal drag. Essentially, the government has frozen the income levels at which you start paying higher tax rates. So even if your pay rise is just meant to keep up with inflation, it can still push you into a higher tax bracket. And the scale of this is significant. Due to this freeze, which is set to last until at least 2028, the number of people paying the top 45% tax rate has already surged to over 1 million. This creates what some are calling the UK's real income paradox. Your nominal wage goes up, but your actual take-home pay and spending power might stagnate or even fall. And for investors, the pain is direct. The dividend tax is climbing to as high as 35.75% for higher rate taxpayers. This all happens as household bills are set to climb. One water provider is signalling a potential 11% increase. Council tax bills are expected to rise by up to 5%, and the annual TV license cost is going up. Even a 4-pack of lager will cost more as alcohol duty rises. Now, get this. These aren't just random market fluctuations. Many of these increases, like council tax and regulated energy caps, are what economists call administered prices. They are set or heavily influenced by government authorities. This wave of administered price hikes creates a major test for the UK's progress on disinflation. The Bank of England is trying to bring inflation down, but these government-approved price increases are pushing in the opposite direction. The pressure is on the Bank of England. After an interest rate cut at the end of 2025, Governor Andrew Bailey warns that future decisions will be, quote, a closer call, leaving markets and mortgage holders in suspense. The decision becomes a closer call because the bank is caught in a difficult bind. We're seeing the real income paradox and fiscal drag squeezing consumers, which argues for cutting interest rates to support the economy. At the same time, this sticky administered inflation from rising bills suggests they may need to keep rates higher for longer to ensure inflation is truly defeated. This conflict is why many experts predict the Bank of England might enter a dovish pause, signalling they want to cut rates but hesitating to do so. This uncertainty could lead to more volatility for the British pound and UK government bonds, especially if the policy paths of the US Federal Reserve or the European Central Bank are clearer. Amid the push and pull of rising costs and wages, one of the most significant changes is set in stone. The government is officially ending the two-child benefit cap. The policy shift will allow families to claim universal credit and child tax credits for all their children, fundamentally reshaping financial support for households across the country. This policy change is essentially a targeted fiscal stimulus, putting more money into the pockets of larger families. Research from the New Economics Foundation suggests this could significantly reduce child poverty. However, this also creates a classic example of policy friction, where fiscal policy from the government might work at cross purposes with monetary policy from the Bank of England. By boosting household income and potentially increasing spending, this policy could add to inflationary pressures, making the Bank of England's job even harder and potentially blunting the effect of its interest rate decisions. The focal point to watch will be how this fiscal boost impacts consumer spending and whether it forces the bank to adjust its strategy.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.